I actually have built a proprietary model which I'd like to share with you
Okay.
today. It is actually sponsored.
Oh, wow. Okay.
This is why fixed income is such an attractive opportunity at the moment, because it's lower volatility, there's heaps of opportunity, and yields are back. So yields are back, bonds are back.
Nice. So we want to start with the transition away from bank hybrids. Why are they so attractive?
There's two reasons to that. The yield attached to them was pretty attractive. Secondly, there was the franking component on top of the yield. Most investors just used to think it's major bank paper, what could possibly go wrong? They're actually extremely volatile instruments.
Australian investors have been big buyers of bank hybrids, be it for income, for franking credits, or just as a defensive play. But with APRA now winding them down, Australian investors are about to find a $40 billion hole in their portfolios. So the question is, what comes next? From Equity Mates Media, this is Basis Points, a show that helps advisors find small improvements that compound into big outcomes. I'm Bryson with my co-host Ren. Today we are speaking to Helen Mason, portfolio manager at Schroders, about the winding down of bank hybrids and where we should be looking to replace them in our portfolio. Ren, good to be with you.
Bryce, good to be with you. Excited for this episode. Bank hybrids. They are a popular feature of the Australian investing landscape, less so overseas. But before we get to our conversation with Helen, we thought we'd just do a brief 101 for people who are a bit less familiar with the hybrids market. So $43 billion of assets in the Australian bank hybrids market. And they really emerged as like a safety buffer, you would call them. If you think about a capital stack, so you've got, equity, junior debt, senior debt, and then for banks, deposit holders.
Yep.
APRA decided that the banks needed another buffer between equity and junior debt, and they said, we'll create these hybrids that are traded on exchange, and their prices move daily, so they're equity-like in that instance. You can buy and sell them at any time, but they pay regular income like bonds. And the idea was that if a bank collapses, you wipe out the equity first, and then you wipe out the hybrids. They were like a buffer. Yeah. And they were popular. They were popular, particularly among Australian retail investors.
Big time. So much so that it's got APRA a little bit concerned.
Yeah, their popularity was the cause of their demise.
Yeah, so APRA have decided to wind up the instrument, and starting in 2027, and they want it all wrapped up by 2032.
And what we mean by their popularity being the cause of their own demise, I think about 40% of the hybrid market was owned by retail investors, and APRA were worried that in the event of a banking collapse, because retail investors had so much money in the hybrid market, it would be really difficult to wipe that tranche of the capital stack. It would be difficult to wipe out everyday Australians, like politically difficult, financially difficult. And so because then they weren't really serving the purpose that they were intended to, they decided to remove them as an option. As we speak about with Helen, hybrids will still exist for wholesale and institutional investors, but it's really just taking the risk out of the retail part of the market. So the question becomes, this popular investment instrument is being taken away from Aussie investors. Where should we go to replace some of those characteristics, to replace that income? And that is what we are speaking to Helen Mason about today. She's a portfolio manager at Schroders. She runs their high yield credit fund with the ticker HIGH on CBOE. And we're going to be talking all things income.
Speaking of CBOE, a huge thank you goes to CBOE, one of our main... Speaking of CBOE, a huge thank you goes to them for being one of our main partners here at Basis Points, along with Milford and Orbis Investments. But particularly today, a big thank you goes to CBOE.
Did you know that Australia has more than one stock exchange? You might have traded on CBOE without even realizing it. With approximately 40% of all Australian ETF trading happening on CBOE, yes, you heard that right, 40% of all Australian ETF trading happening on CBOE. They understand the growing interest in ETFs among Australian investors.
So to find out more about their listings, head to CBOE.com.
Now, before we get into it, a reminder for all advisors listening that every episode of Basis Points is accredited by the Financial Advice Association of Australia for CPD points. To claim your CPD points, click the link in the show notes or the YouTube description. You'll complete a 3-question quiz about the episode and we'll email you your certificate to claim those points.
Alrighty, well, with that said, let's get into our conversation with Helen Mason. Helen, welcome to Basis Points.
Hi.
So we want to start with the transition away from bank hybrids. They've been an incredibly popular product for Australian retail investors. Why are they so attractive?
Well, I think there's 2 reasons to that. One is that the yield attached to them was pretty attractive. Secondly, there was the franking component on top of the yield. So essentially what hybrids are is a debt instrument that sits within the banking capital stack that, is there to provide loss provision, So essentially if a bank goes into default or has a point of non-viability is what is called in banking terms, essentially what happens is the first component is equity disappears. Then you would eat into your tier 1 or your bank hybrids. So that's essentially where they sit. So they are a form of debt and equity because they do have equity-like characteristics attached to them. They very much trade like equity and they're franked as well. So I think that was the most attractive part of them. And, investors would just buy them, they'd sit there, deliver them regular coupons in their portfolio.
The term capital stack, just for people who are unfamiliar with it, you explained part of it with equity and hybrids, but do you want to just give people the full 101?
Yeah, well, I actually have built a proprietary model which I'd like to share with you
Okay.
today. We're rolling it out and it is actually sponsored by Fisher Price.
Oh, wow. Okay.
It's
Love
called
that.
My First Bank Capital Stack. So essentially,
Now, just for people who are just listening,
Hold it up as you go so you can...
here.
Yeah. There we go.
People who are watching on video, we have I guess
Like a
how you
quote,
describe
kid's
it,
quotes?
a kid's quote. Yeah, good description. Representing the capital stack. 5 different levels. So what are we saying?
What have we got here? So the first level, so basically this is how the bank capital stack is built. The first level is you've got equity, which can be exciting and fun. So it has a rattle in it.
Oh, nice.
Great.
Nice.
Love that. So when a bank goes into essentially, a period where what happened with Credit Suisse, for example, where there was loss of confidence by depositors and essentially, individuals trying to get their money back. The first port of call is equity disappears or is written down.
Gone.
Off it goes.
Yeah.
Right. Nothing left. Tier 1 hybrids are then next in the firing line. Okay. So they either can be converted to equity or completely written off. Also gone. The next component in the bank capital stack is the tier 2 paper. So again, it's subordinated debt, but it sits above equity and tier 1. So it's slightly safer, less risky. So I should point out, as we go down this thing,
Stack,
whatever
yeah.
this,
Yeah.
the pole, you're attracting less risk to your
Yes,
investment. Then you have your senior debt, which is next in line, and then your deposits. Now, the government doesn't want to touch these, right?
No,
This is a big problem. So essentially what happens, and that's what we've seen in all banking kind of scenarios where we've actually had defaults on banks, is that the government steps in and protects deposit holders. That's typically what has happened. But essentially, governments don't want to do that. So what they want to do is make sure that what we've got going on here is really tight to protect that. So that's essentially what the bank capital stack is and how it works in the event of a banking default.
And so hybrids as a concept were like an additional layer of protection to absorb some of the shock if something went wrong.
Correct, yes.
On the investor side, how were you seeing Australian investors use them in a portfolio?
Okay, well, most investors just used to think it's major bank paper, what could possibly go wrong? Well, arguably, yes, we do have one of the safest banking jurisdictions in the world. Like our regulators are probably, over the top compared to international banking standards, which is good for us, right? We also have a very stable banking system in that most of what they do is not very complicated. So we're not prop traders or anything like that. It's just resi mortgages, business lending, even commercial real estate is not really done by the banks anymore. It's actually done by, private debt, private lenders. And so, you'd probably say that stuff was the most risky that they used to do, and they don't even do that anymore. So we do have a very stable banking system. The one thing I'd point out about them though, is the risk that's attached to them in terms of the volatility. So these things actually trade like equity. So if I give you an example, in 2023, when we saw SVB Bank and Credit Suisse, etc., all of those shenanigans happening, our fund, the high yielding credit fund, was down about 40 basis points. So had a drawdown of about 40 basis points. Pearls 13 had a drawdown of 2.5%, so 250 basis points.
And for people unfamiliar, what is the Pearls 13?
So that's a hybrid, a bank hybrid. So that's one of these instruments here. So, something that people are buying and thinking that nothing ever happens to them, they're actually extremely volatile instruments. And so when you think about that in the context of a defensive portfolio and an income portfolio, that's the risk that you're taking, is that in any given month, you're potentially have the downside of being exposed to significant equity-like drawdown.
And now the hybrid's success in some ways has probably paved the way for their own demise because they were so popular around retail investors. I guess APRA started to get worried around the ability for banks to write that level of the capital stack off if things went wrong. And so they've made the decision to wind up hybrids as an instrument. And that's what we really want to talk about today, because all of a sudden a lot of Aussie investors are going to have holes in their portfolio and they're going to be looking for things to fill it, particularly to fill that income gap. But timing does matter here, because the transition away will start in 2027, but it won't be completed until 2032. So why is it something that we should be thinking about today rather than 2031?
Well, actually, the transition starts today. We've actually had two hybrids, so a CBA and an ANZ bank hybrid have already gone. They went in February, so they already got called and matured. But then also we've had the Westpac Capital Notes 5 that have been called, so they will mature in September, so this month. So the process is already underway. And I think, people have had this magical 2032 number in their heads. And actually that 2032 date only applies to one bond. It's a NAB bond and it's about $1 billion outstanding. Oh, right. So during this period, from now until 2032, everything else is effectively going to be called. So will be paid back. And there's two things I want to mention about that. One is that about 40% will be gone within 4 years. So 40% is gone. So if you think about retail exposure is about kind of like 40, it's about 40% of 40 billion, 40% of that is disappearing. So that's a lot of money that's going. The other point to raise here is pricing. And those bonds, so every single bond, hybrid security at the moment is trading above par. So what do you get? What happens when they get called on their call date? Do you get 103 back or 104 back? No, you get 100 back.
Why is that? Why are they all trading above par? Why is demand so high?
Demand has always been so high for these instruments, and it's a reason why we never held it in our portfolio. Because the cash pay to us matters. We don't care about franking because we're a unit trust. So, we don't get any franking benefits. So essentially for us, we loved wholesale hybrids because the yields were better because there was less demand for them. But again, as I said before, retail investors have just loved these things. It's major bank paper. Look at CBA. CBA equity is as much loved as no one can get out of it now because they won't pay the capital gains. But, it's kind of everyone's loved these things for so long that, they've been trading above par almost since they were issued. So the point we're trying to kind of get out and talk to investors today is that you're guaranteed to make a capital loss, and that affects your total return at the end of the day. So what we're saying is that have a think about, maybe transitioning from those hybrids and looking at other opportunities in the market, even though you're really attached to kind of that franking, that franked income. But there are some really other compelling opportunities in the market today.
Well, let's use that as the segue. Where should investors be looking for the replacement for that income? Like, what are some of the viable replacements?
Yeah. Well, interestingly, we did some roadshows recently, and we were going out talking to different, brokers, advisors, across the country. I asked a question: how many of you are holding income, like equity for income, in your portfolios today? And like everyone's putting their hands up. But when I was saying like the dividend yield on the ASX 200 is 3.2% today. So if you frank that, you're getting another % on top of it, right? That's quite rubbish from an income perspective.
Yeah. I mean, it's good from an equities perspective, but from your world, it's
and essentially, remember, we go back to our capital stack here. Remember, equity is the most risky. So I should be paid the most to be sitting up here, yeah? I should be paid the least for sitting down here, right? That's actually, that's not what's happening today. At the moment, you're being paid more to sit here and here than you are up here. So, for example, if you're thinking like you're getting 4.4% on a franked ASX 200 at the moment, or let's use Woolworths as an example. A Woolworths, the dividend yield on Woolworths is 2.9%, bearing in mind their earnings were quite rubbish. They were down 19%, so they had a weak result. But if I buy a Woolworths bond today, a senior bond, I'm getting over 5% on that, and I'm here. I'm holding it up again. I'm in the green bit. Yeah. I'm not in this jazzy bit. So essentially, this is what's happening at the moment, and this is why fixed income is such an attractive opportunity space at the moment, because it's lower volatility, there's heaps of opportunity, and yields are back. Yields are back, bonds are back.
Yeah, bonds are back, and like we see it in what's coming through our a pipeline of experts and different funds coming to market, and fixed income is back, bonds are back. Also, private credit is the buzzy part of the market. It's like investors are chasing income at the moment, it seems.
Yeah.
So can you guys just give us a view on the different options available for investors looking to fill an income-sized hole in their portfolio, and why you think Australian public credit or Australian public debt is the better good choice?
Yeah, it's the better spot. So, I'll talk about private credit in a minute, but the reason why Australian public credit in particular is so attractive, there's a couple of reasons for it, is our index versus, the credit indices overseas, so the US and Europe, is super, super high quality. In fact, it's about 2 rating notches higher. So we're like typically A+, they're like A-.
Yeah, right.
And so the reason for that is because we have this amazingly strong banking system. So the banks issue most into the credit markets, as you would expect. But we also have other really high quality businesses which have highly regulated cash flows, but also are inflation linked. And so if you think about what's issuing into Australian public credit universe, actually 60% of our issuers are unlisted. So you can't get hold of these issuers through the traditional equity markets. So it does give you that element of diversification.
Oh, okay. Can you just give us an example of some of those big names?
Yeah, so Sydney Airport, Port of Brisbane, Port of Newcastle, Transgrid, which is electricity, utilities, distributions, poles and wires in the street, that type of stuff, which is, monopoly infrastructure. Really, really high quality, but also they need a lot of debt because they've got a lot of stuff to do. So, for example, the energy transition has meant a lot of these guys are actually having to issue more debt because they have to make transitions and provisions for us rolling into renewables, etc., and how the grid is going to cope with that. But also, if you look at Melbourne Airport, did a hybrid, corporate hybrid recently, which is wholesale only. So, it's suitable for purpose. But they're building a third runway And so they need a lot of capital up front. They don't want to damage their credit rating because that's really important for their senior debt. So what they do is they issue a corporate hybrid. This is a growing space in the debt capital markets in Australia, which means it has equity and debt-like characteristics.
Are corporate hybrids also being phased out, or is it just the listed versions?
Just the bank hybrids. So in fact, insurance companies will continue to issue tier 1.
Oh, right. Okay.
And this is a phenomenon that is actually only happening in Australia. New Zealand are also looking at whether they phase out tier 1 capital, but it's actually only happening in Australia at the moment. And part of the reason for that is we had this unique situation where we allowed retail investors to invest in these instruments.
Right.
Overseas, that is not allowed. It's a wholesale instrument where people really understand the conversion risk. And well, I say that, but actually when Credit Suisse collapsed, people hadn't really read the bond documents. And in fact, what happened in the Credit Suisse scenario was this stayed and this got written off.
Yeah, right. Okay.
So that was unique to Switzerland.
So that scenario wouldn't happen in Australia. No. The equity would get wiped out first and then the hybrids. Yeah, okay.
Yeah. So but the point I'm trying to make with all of this is they're complicated.
Yeah.
There's like loads of things around this. Like, that this is complicated stuff. And I tell you what, I don't know if you've picked up a hybrid documentator prospectus. It's like that.
Jeez.
So, you've got to have a lot of love. You've got to have a lot of love for that to go through those documents, which we do because we're paid to do it.
Yeah.
But yeah, it's complicated stuff here. And so, when we talk about other opportunities, particularly Australian credit is mostly in this band here and the tier 2 space, which is, wholesale only, professional investor markets, and it's not accessible to the retail investors.
Yeah, well, I mean, that the thing that we're loving is that more and more fund managers are creating listed versions of their products, so they become listed.
Yeah.
And you've obviously got one with one of the better tickers in the space, I would say.
Yeah, we're getting high.
The ticker is high,
on our bonds.
Did you have to fight hard to get that ticker?
We actually didn't. We've got a guy who works with us in the team, and he is just gold at finding tickers. So, it's like he finds all our good ones. We have another fund called Grow, another one called Pays.
Yeah.
So, we got good tickers. Yeah.
So, if we get back to the hybrids, you mentioned earlier one thing that people found quite attractive about them was franking credits.
Yes.
We know Australians love franking credits.
Love them.
So I guess the Australians who have been relying on hybrids for those franking credits are going to lose access to them.
Yes, correct.
But can you talk about how the total return profile compares in some of the other parts of the capital stack?
Yeah, so well, I'll give you an example of our fund versus the hybrids themselves. So the selective hybrid index, which is the franked return that you're getting. Our fund, so high yielding credit fund, is the unit trust, which has been running since 2001, by the way. It's a long-term fund. That has outperformed the selective hybrid franked index by over 1% over the last 2 years and by over 50 basis points in 3 years. So essentially, the point we're trying to get across to people is you actually don't need the franking to achieve those kind of returns. It's just that this particular point in the capital stack really hasn't been available or really easily available in an ETF type format for quite some time. I mean, fixed income coming into the ETF format is relatively new. And so, what we actually call this kind of tier 2 and senior debt space is, Australian credit is the institutional investor's best kept secret because it has significantly delivered alpha to many multi-strategy fixed income portfolios for a long period of time. So we've been doing this for a long period of time. It just hasn't been available or, retail investors haven't been really aware of it. Yeah.
So we want to drill into the market here in Australia.
Yeah.
It's a market that probably is not as familiar to everyday investors as shares and hybrids as we've spoken about.
Yeah.
So what does the market actually look like? What's the size of the opportunity set? Who are the big names issuing debt? Just kind of give us a bit more flavour.
Yeah, the flavour. So there's flavour and there's MSG in this market. So like so we love the MSG in this fund, but so essentially, as I mentioned before, it's a market that's built up of really good sectors. So we've got, anything from, very close to government owned or government backed kind of businesses like Air Services Australia, which is, they own the skies, they own, air traffic controllers, etc. So we've got that in our index, all the way down to, sub-investment grade rail providers, so who work on the above rail, so on the tracks, delivering grain to the ports or coal to the ports, etc. So we have, vast variety. We have universities, banks, utilities, airports, everything going on in credit. As I mentioned before, 60% is unlisted. I gave you some of those names. We also have the listed names, which you guys would know, Coles, Woolworths, Volkswagen, those types of names coming into Australia to issue. So if I break it down, there's obviously the banks who have to issue into their capital stack. So they've been doing more subordinated debt because we're getting rid of this. So they had to issue a little bit more equity and a bit more tier 2 because they still have to have this buffer, but it's being made up of tier 2 and equity now. So tier 1 is gone. So that's been happening. But also what we're seeing more is the offshore banks issuing into Aussie dollars into Australia, and that also comprises or makes up the volume in the universe. So we would say overall it's over $1 trillion,
Wow.
The universe size at the moment, and it's growing really fast. So we had about 17 billion of financial issuance last month.
Wow.
So, that's just for 1 month. So we're tracking really well. So partly what's happening and why these companies are coming to Australia to issue is that in the past we've been seen as kind of illiquid, difficult to get deal sizes done, not many investors in that space. That's changed, and it's changed for a couple of reasons. One is that Chinese growth has rolled off. And so where these companies would traditionally issue into the Asia Pacific debt capital markets and China would be issuing into the JP Morgan credit index, China's doing a lot less issuance these days because these companies are not growing, so they don't have as much capex to do. And so therefore their debt load shrinks, as you would expect. But what's happening is all that capital that used to buy into the JP Morgan, Asia Pacific credit index is going, I want a home, please give me 6% somewhere. Yeah. And they're going, so they're actually flowing into Australia, like markets like Australia and Europe, not so much the US because the US credit markets are super expensive at the moment and there's a lot of volatility. So, we kind of say the US is really very much priced to perfection at the moment. And given the political turmoil over there, there's a lot of risk kind of baked in there.
Yeah.
So Europe and Australia is looking pretty attractive vis-a-vis what's going on elsewhere. So we've got more demand coming into this market, which you would argue and go, okay, well, what does that mean for local investors? You're getting less risk premium, because that's shrinking as you get more demand. Well, actually, it's done the opposite. It's encouraged more supply. So it means that as these issuers come to Australia, they know that they can get these deals printed. So they can do 500 or $1 billion or $1.5 billion, or even 4 billion if you're a major bank. You can actually get these deals done now because there is capital and investment there ready and waiting to go. So it's a really positive development that's happened in our market. In fact, the Australian credit market, the index, has grown over 50% in the last 5 years.
Wow.
So it's massive amount of growth.
Yeah, that is massive. So you mentioned there that America is priced to perfection. Maybe if you can compare how Australia looks compared to the US to just illustrate, I guess, the different opportunity sets.
Yeah, so if I talk in terms of the spread or the credit risk premium, which is the bit that we care about because cash is cash, so that we care about what you're getting above cash in the yield stack. So essentially your credit risk premium is what you're being paid to take the risk on any given company. So essentially in Australia, we're being paid, close to 30 basis points more than you would be paid for the same type of risk in the US that we're being paid over here today.
Wow.
So, it's a lot better value here.
Nice.
And arguably our companies are better quality. I mean, you would say that triple B companies should all be the same. They're actually not, because I would rather invest in a triple B that's highly regulated with stable, transparent cash flows than a triple B retailer, for example, that's at the whim of the cycle. Yeah.
Are there any other differences that we should know about when it comes to like comparing Australia versus global peers?
Yeah, well, as I mentioned before, the total index quality is higher. I mean, obviously, we've had this changing dynamic of removing tier one capital. But the other point I'd like to mention is that I said offshore banks will still be issuing tier one capital into their markets. They can also come to Australia to do that, and we can buy it. So we can still access, as long as it's issued in Australian dollars, UBS might come and do another wholesale hybrid, which they had one before. They might come out here, Barclays Bank, Lloyds, etc. They can all come out here and still issue tier one, which wholesale investors like us can buy in our fund.
All right.
Interesting.
Yeah.
So if I kind of just sum up where we're at, tier one bank hybrids were very popular for Aussie retail investors. I think you mentioned 40% of the $40 billion market.
Yeah.
So what's that? 16 billion? So that money is now needing to find a home.
Needs a home. Yeah.
And whilst it might hybrids might be around until 2032 in some way, shape, or form, it's a diminishing pool. Prices are above par, so if you're buying them now, you're going to make a capital loss when they get redeemed.
Yeah.
And as we said, there's a diminishing supply.
Yeah.
But the good news for Australian investors is that there are more and more credit strategies, such as the one that you guys run at with the ticker HIGH, where the total return is actually beaten hybrids.
Yes.
That's good to know.
Yes.
Then I guess is, digesting all that information and putting my, investor hat on and thinking about what I want to do. It's then, all right, well, what of the opportunity set that exists in the, credit fund market, how do I distinguish between them? What should I be looking for and where should I go? So, obviously, you think we should be looking at HIGH, but I guess help us distinguish like what factors we should be looking at.
I love this question.
Yeah,
this is such a good question.
The amount of choice is overwhelming. So help us be less overwhelmed.
Yeah, so we've done a whole heap of work into our competitors in this space, and we mentioned private debt earlier.
Yes.
Now, we consider private debt's fine to invest in as long as you're funding it from your growth bucket. That's really where private debt should sit in terms of the level of risk that you're actually taking. It's not a fixed income instrument. And so we've always said that for quite some time.
And just for people who want that explained, you're saying that private debt is riskier than public debt.
Yeah, and there's a couple of reasons for that. And actually APRA are starting to do and are investigating what's actually happening in private debt land, because it is very opaque and you don't get 14% returns, which incidentally they're not 14% anymore, they're more like 8%, but you don't get those type of returns without taking a considerable amount of risk. So risk isn't just volatility. Risk is, loss of default, loss given default, etc. You need to think about that in the whole context. And the problem is with a lot of these private debt portfolios, which have grown up so fast, there's just been so much capital flowing into them, is that the underwriting standards within these loans has fallen quite significantly. So before, maybe you were funding a commercial real estate project, which had a 65% LVR, loan to value ratio. Now it's at 80% because otherwise you can't print the loan. But with the weight of capital coming in, these kind of funds have just needed to keep writing loans in order to get the money through the door. So they had to find a home. Otherwise your returns fall too much cash. So there's that. But also, a large proportion, so over 50% of deals written in the private debt land in Australia last year were actually commercial real estate debt. Now Schroders invests in commercial real estate, but we know exactly what we're buying and we know the type of returns that we actually should be receiving or should be attached to the level of risk that we're actually taking in that space. Those are not the type of returns that we're seeing in these listed private debt vehicles. So, there's a lot happening. The other thing is fees. They're very, very high, and they're actually sometimes higher than investors realise, because there's a thing called an establishment fee, which is, that's the MSG on a private debt fund. And that essentially is, money for old rope, really, because essentially what happens is I come to you and I say I want a loan, and you say, absolutely, I'm going to, charge you an 8% interest rate, but you're also going to pay me 2% just for the sheer love of it, right? Just because I feel like it's going to take me a lot to do the paperwork. So here's an establishment fee of 2%. I go, oh, okay, well, I've got no choice because, I'm a constructor and I'm in the middle of my project and, I need to do this. So I give you 2%. Sometimes that 2% doesn't go back to the investor. It stays with the origination.
Right. Yeah.
So, we just need a bit more clarity, I think, and this is what, our regulators are coming in and saying. We just need to have more understanding of where that's all going and what fees are really being charged and what the risk is that people are taking in these investment instruments. Is there any contagion that would potentially flood into the banking system, for example, if anything went wrong?
So that's why private debt and public debt aren't the same. And so as you're putting, your investor hat on and trying to choose between the two, I think it's important to understand those two things aren't equal.
Yeah.
So then in the public debt space, what should we be looking for to distinguish different fund managers?
Yeah. So another part of it is that, so a lot of these kind of credit funds include something called structured credit, which we actually invest in, residential mortgage-backed securities, RMBS, in our other portfolios. They do have a different trading profile. So when we say we want to offer daily liquidity to our investors, we mean we want to provide daily liquidity to our investors. Some of these instruments in structured credit land, so ABS securities and, poorer or, weaker collateral RMBS securities are actually much less liquid. And in some cases, they're completely illiquid because the tranches are so small. They just don't trade in the open market. And so for us, we don't include any of that to try and enhance our returns. We just want to keep things nice and simple, nice and liquid, offering monthly distributions. And so when you're thinking about funds that make sense for you, it's not just a return story. It's actually what's underlying those returns? How are you building up those returns? And, what I will say is we're competing and either exceeding the returns of those funds that are using structured credit or private debt, for example, and we're still in line with those guys, if not exceeding them, but we don't actually have to muddy the waters with complexity or illiquidity to do so. So just be aware of that. Yeah.
Well, Helen, to close it out, do you have any final thoughts for advisors who are trying to sort of build resilient income portfolios for their clients, or particularly how they should be thinking about high?
Yeah, well, if you're thinking about income and you're thinking about your defensive part of the portfolio, just think about when you're building a portfolio, think about the characteristics that sit within an investment that should be within the defensive portfolio, and so you're thinking about through the cycle income, through the cycle returns. You're not just thinking about what's happening today. And there's a lot of risk that's building in the system. Prices are getting tight in equity markets, in global credit, in private debt even. So have a think about what defensive really means to you and your clients, and then think about where you want to position yourself.
Love it. Well, Helen, thank you for joining us today. If people want to find out more about what you're doing or the High Fund, we'll include links in the show notes.
Yep.
But we really appreciate you coming and sharing your expertise. And our favourite toy.
Yes. We've got to put that on the
It's the best,
shelf.
isn't it?
Yeah. That's going to be what I'm, whenever a friend has a kid, that's what I'll be buying them.
Yeah, and you can teach them about the capital stack.
I love that.
To be honest, Bryce and I probably haven't graduated beyond Fisher and Paykel's My First Capital Stack, but that's why we appreciate you coming and teaching us.
Thank you for having me.
Thanks,
it's been
Helen.
fun.